Silver is once again making headlines across the global financial markets, and investors everywhere are watching every movement very carefully. After one of the most violent weeks the precious metals market has seen in recent months, silver has started climbing once again. But this recovery comes with a massive amount of uncertainty. Traders, analysts, bullion banks, central banks, and retail investors are all trying to understand whether this latest move is simply a temporary rebound after a brutal correction, or the beginning of something much bigger that could reshape the entire precious metals market over the coming years. At the start of the week, silver managed to push higher once again, recovering part of the losses from last week's collapse. On the surface, the gains may not appear dramatic, but when compared to the extreme volatility investors experienced only days earlier, this move suddenly becomes much more important. Silver has become one of the most unpredictable assets in global markets right now, and that alone is attracting huge attention from both institutional and retail investors. Only days ago, silver was trading near the $87 level before collapsing rapidly toward the mid-70s in what many traders described as a panic-driven liquidation event. Intraday charts showed an even more dramatic swing, with silver briefly touching near $90 an ounce before crashing down close to 76. That kind of movement is extraordinary even for silver, which has historically been known as one of the most volatile commodities in the world. A $14 move in such a short period signals that powerful forces are currently battling for control of the market. Many investors are now asking the same question. What exactly is happening behind the scenes? Is this simply speculative trading, creating temporary chaos? Or are we witnessing the early stages of a much larger financial shift involving global currencies, inflation fears, interest rate expectations, and the future of precious metals themselves? One thing is becoming increasingly clear. Silver is no longer behaving like a quiet industrial metal. It is now moving like a strategic global asset, and the entire world appears to be paying attention. At the same time silver is attempting to recover, gold prices have remained relatively stable. Gold has not experienced the same level of violent swings, which is important because it highlights how different the psychology behind silver currently is. Investors often see gold as stability and silver as opportunity. When fear dominates the markets, capital usually rushes toward gold first. But when speculation and momentum enter the picture, silver tends to move much faster in both directions. The gold-to-silver ratio has also become one of the most closely watched indicators in the market right now. With the ratio dropping below 60, many analysts believe silver may have become relatively overextended compared to gold in the short term. Historically, when the ratio falls aggressively, some investors begin shifting their attention back toward gold because they believe silver has moved too far too fast. Others argue the opposite, claiming that silver is still massively undervalued compared to gold when viewed from a long-term historical perspective. This debate has become central to the current market environment. On one side are investors who believe silver is entering a new supercycle driven by industrial demand, monetary uncertainty, and global supply shortages. On the other side are traders who believe recent price spikes were fueled mainly by speculative mania and leverage futures positions that could continue unwinding if economic conditions worsen. Adding even more pressure to the market is the growing uncertainty surrounding global monetary policy, especially in the United States. Investors are now closely watching the Federal Reserve after major changes in interest rate expectations appeared almost overnight. For months, markets had been betting that interest rates would eventually fall. Many traders expected economic weakness to force central banks into rate cuts sometime within the next year. But that narrative has now changed dramatically. According to recent market projections, expectations are shifting toward the possibility that rates may remain elevated much longer than previously anticipated. Some analysts are even discussing the possibility of additional rate hikes if inflation remains stubbornly high. That is extremely important for gold and silver. because precious metals typically struggle in environments where interest rates stay elevated for extended periods. When rates rise, holding cash and bonds becomes more attractive because investors can earn stronger returns from yield-bearing assets. Precious metals, by contrast, do not generate interest. This creates pressure on gold and silver prices, especially when investors believe central banks are determined to keep monetary policy tight. Markets are now assigning extremely high probabilities that rates will remain unchanged at upcoming Federal Reserve meetings. More importantly, forecasts stretching into next year suggest very few expectations for major rate cuts. That shift alone may explain part of silver's sharp correction last week. But now, another major development is entering the picture. A new Federal Reserve chair is expected to take office this Friday, and investors are preparing for potentially market-moving statements. Leadership changes at the Federal Reserve always create uncertainty because markets immediately begin searching for clues regarding future monetary policy. If the new chair signals support for easier monetary conditions or expresses concern about economic weakness, precious metals could respond positively. However, if the new leadership continues emphasizing inflation control and higher for longer rates, gold and silver could face renewed pressure. This is why investors are preparing for another highly volatile week across the metals market. Beyond the United States, global developments are also creating major shifts in silver demand. China, for example, continues aggressively increasing silver accumulation. Reports now indicate Chinese silver vaults have reached their highest levels in months, and buying activity has accelerated dramatically. In fact, recent purchasing data suggests China acquired more silver last month than during any comparable monthly period over the past 2 decades. That kind of accumulation is impossible to ignore. Whenever a major global power begins aggressively stockpiling strategic commodities, markets immediately begin speculating about the underlying reasons. Some believe China is preparing for increased industrial demand linked to renewable energy technologies, electric vehicles, and advanced manufacturing sectors that require enormous quantities of silver. Others believe China may be positioning itself ahead of future monetary instability or global financial disruptions. Silver plays a critical role in modern technology. It is used in solar panels, electronics, semiconductors, batteries, medical equipment, and numerous industrial applications. As governments around the world push toward electrification and green energy infrastructure, silver demand could continue rising significantly over the next decade. This industrial demand story is one of the strongest bullish arguments for silver right now. Unlike gold, which is primarily viewed as a store of value, silver has dual functionality. It serves both industrial and monetary purposes. That creates an entirely different market dynamic. At the same time, physical silver inventories remain relatively constrained. Mining production has struggled to keep pace with growing industrial demand, and some analysts believe future shortages are possible if investment demand accelerates simultaneously. That combination of industrial necessity and investment interest is precisely why many silver bulls believe prices could move substantially higher in the coming years. But perhaps one of the biggest developments receiving attention right now is happening in Singapore. A brand new silver futures contract is being launched, and many market observers believe this could become a serious competitor to Western futures exchanges. The new Singapore-based silver futures contract will reportedly be physically deliverable and denominated in US dollars. This detail is extremely important because it changes the conversation surrounding physical silver ownership versus paper trading. For years, critics of Western futures markets have argued that silver prices are heavily influenced by paper contracts rather than actual physical supply and demand. Many believe large financial institutions and bullion banks have used derivative markets to suppress silver prices through leveraged trading activity. Whether those claims are entirely accurate remains heavily debated, but the perception itself has fueled enormous distrust among retail silver investors. Now, with additional physically deliverable contracts emerging in Asia, some analysts believe pricing power may gradually shift away from traditional Western exchanges. Supporters argue that greater emphasis on physical delivery could reduce opportunities for excessive paper leverage and improve price transparency over time. If more investors demand actual delivery rather than cash settlement, the silver market could tighten considerably. That possibility is one reason many precious metals enthusiasts are closely monitoring this Singapore launch. They believe it represents part of a larger global shift toward physically backed commodity trading systems. At the same time, another major development is unfolding in India, one of the world's largest consumers of silver and gold. The Indian government has now moved to restrict silver imports across nearly all forms, sending shockwaves throughout global bullion markets. This decision is incredibly significant because India has historically been one of the largest sources of global physical demand for precious metals. Indian households have long viewed gold and silver as trusted stores of wealth, especially during periods of currency weakness or economic uncertainty. Reports indicate the restrictions were implemented as part of broader efforts to reduce pressure on the national currency and control import levels. Authorities appear concerned about large volumes of money flowing into precious metals instead of remaining within the domestic financial system. Earlier measures had already increased import tariffs on gold and silver substantially. Now, with additional restrictions targeting silver investment imports specifically, many investors believe governments are becoming increasingly uncomfortable with citizens shifting wealth into hard assets. The implications are massive. If India reduces silver imports significantly, global demand patterns could shift dramatically. Domestic silver supplies inside India may tighten, potentially driving local premiums higher. Consumers could end up paying far more for physical silver than international spot prices suggest. At the same time, reduced Indian demand could temporarily pressure global prices if fewer shipments enter the country. But the bigger question becomes where that silver will go instead. Some analysts speculate that silver originally destined for India could be redirected toward Asian financial hubs like Singapore, especially as new futures contracts and physical delivery systems emerge. What makes the situation even more interesting is the psychological impact these restrictions may create among ordinary investors. Historically, whenever governments restrict access to hard assets, public interest in those assets often increases rather than decreases. Many investors view gold and silver as protection against inflation, currency devaluation, and financial instability. If people begin losing confidence in fiat currencies, demand for physical metals can accelerate rapidly. This is particularly true in countries experiencing rising inflation or weakening purchasing power. Supporters of precious metals often argue that fiat currencies are inherently vulnerable because governments and central banks can create unlimited amounts of money through monetary expansion. Gold and silver, by contrast, cannot simply be printed into existence. Their scarcity is precisely what gives them perceived long-term value. That argument has become increasingly popular in recent years as inflation concerns spread across global economies. Following years of aggressive monetary stimulus, rising government debt, and economic uncertainty, many investors have started questioning the long-term stability of paper currencies. This growing distrust is helping fuel renewed interest in physical precious metals ownership. Investors are no longer viewing gold and silver solely as speculative trades. Many now see them as financial insurance. At the same time, the debate between physical ownership and paper investments continues intensifying. Exchange-traded funds and paper silver products offer convenience and liquidity, but critics argue they introduce counterparty risk and disconnect investors from actual physical supply. Supporters of physical ownership believe holding real bullion removes dependence on financial intermediaries and protects investors during periods of systemic instability. This philosophy has become especially popular among retail investors concerned about banking risks, inflation, and market manipulation. The current silver market therefore sits at the intersection of multiple powerful forces, all colliding simultaneously. On one side, there is growing industrial demand linked to technological transformation and green energy infrastructure. On another side, there is rising investor demand, driven by inflation fears and currency uncertainty. Meanwhile, central bank policies, geopolitical developments, futures market reforms, and global trade restrictions are all influencing supply and demand dynamics in real time. This creates an environment where volatility becomes almost unavoidable. Silver has always been known for dramatic price swings, but the current environment feels different to many experienced traders. The scale of recent moves suggests underlying structural changes may already be taking place beneath the surface. Even the broader market capitalization rankings of global assets are reflecting this instability. Silver's position among the world's largest assets has fluctuated rapidly, moving between major technology companies and competing with some of the largest corporate valuations on Earth. That alone demonstrates how massive the silver market has become during this latest rally phase. And yet, despite all the excitement, uncertainty remains everywhere. Some analysts believe silver could continue correcting lower if global economic conditions weaken and higher interest rates persist. Others argue any significant pullback will simply attract more physical buyers eager to accumulate metal before future shortages emerge. There is also growing speculation that central banks themselves may increasingly influence precious metals markets over the coming years. As geopolitical tensions rise and nations seek alternatives to dollar dependency, gold and silver could become more strategically important at the government level as well. This is one reason investors are paying extremely close attention to Asia right now. China's accumulation activity, Singapore's futures expansion, and India's import restrictions are not isolated developments. Together, they may represent broader shifts occurring within the global financial system itself. For decades, Western financial institutions largely dominated global commodity pricing mechanisms. But now Asian markets are becoming increasingly influential, especially in physical commodities and precious metals trading. If pricing power gradually shifts toward markets emphasizing physical delivery rather than leveraged paper contracts, the silver market could experience major structural transformation over time. Whether that leads to significantly higher prices remains uncertain, but it would certainly change how the market operates. Retail investors are also playing a larger role than ever before. Social media, online communities, and alternative financial media have dramatically increased public awareness surrounding silver markets. Information now spreads globally within minutes, and retail traders can coordinate buying activity at unprecedented speed. This creates additional volatility because market sentiment can shift rapidly based on news events, government policies, inflation data, or central bank commentary. Emotional reactions now travel through financial markets almost instantly, and right now emotions surrounding silver are extremely intense. Some investors see opportunity, others see danger. Some believe silver is heading toward triple-digit prices, while others warn the market remains vulnerable to violent corrections. But regardless of where prices move next, one thing is undeniable. Silver has returned to the center of global financial conversation in a way not seen for years. Every major development now appears interconnected. Federal Reserve policy, Asian commodity exchanges, industrial demand growth. Inflation fears, currency pressures, and geopolitical uncertainty are all feeding into the same story. That story is no longer just about a precious metal. It is about confidence in the global financial system itself. Because whenever investors begin rushing toward hard assets, it usually signals deeper concerns beneath the surface. Markets are ultimately driven by trust. Trust in governments, trust in currencies, trust in central banks, trust in economic stability. And when that trust weakens, gold and silver often become the assets people turn toward first. This is why the coming weeks could be extremely important for the precious metals market. Investors will be watching Federal Reserve commentary, interest rate projections, Asian trading volumes, physical delivery trends, and global demand data very closely. Any major shift in one of these areas could trigger another massive move in silver prices. If inflation remains elevated while economic growth slows, precious metals could attract renewed safe haven demand. If central banks eventually pivot toward easier monetary policy, silver may gain additional momentum. But if rates stay high and recession fears intensify, volatility could remain extreme. At this stage, the market appears caught between competing narratives, and that tension is creating enormous uncertainty. Still, for long-term believers in precious metals, the broader thesis remains unchanged. They argue that throughout history, gold and silver have repeatedly survived economic crises, currency collapses, and financial system failures, while paper currencies eventually lost value over time. Whether one agrees with that perspective or not, it is clearly influencing investor behavior right now. The silver market is no longer just reacting to traditional supply and demand. It is responding to global anxiety, monetary uncertainty, and shifting economic power structures across the world, and that is exactly why every move in silver prices suddenly feels much bigger than the numbers themselves suggest.